Tyler Crow, $100 oil is back, baby. Okay, it's a technicality, right? There are some, and you can talk about the nuance of this. There are some contracts out there for certain oil that are above $100 a barrel. If you look at West Texas crude, you look at Brent crude, the two major benchmarks that affect most of the world's oil and most of the U.S. oil, we're still in the 90s. We're not quite to 100 for those, but oil's expensive. Tyler, I think that's the point. And there's a lot of investors that are trying to figure out how to capitalize. But also, there's some mistakes that you and I both think investors should avoid. Tyler, what are we going to do, buddy?
The short answer, probably sit around and see what happens, but we can get more detailed than that.
We've actually got some actionable stuff. We do. I'm Jason Hall. This is The Smattering. Before we get to the actual actionable stuff, just a reminder, The Motley Fool is our sponsor for our videos. So please go to our special link, fool.com/The Smattering. The Motley Fool is going to give you its 10 best stocks to buy right now. Be sure to check that out. You know what? You can do it right now if you're already bored with us. That's fine. Whatever you want to do. But no, let's get back to it, Tyler. So again, what's the technicality? Where are we that actually there is some $100 oil that's trading hands right now?
Oil is a very, very broad term for things that can be much more specific. Oil has a whole bunch of different characteristics. It's basically how it's composed when it comes out of the ground. And some types of oil are better at making certain products.
Yeah, so you pull oil out of West Texas versus out of one of the big fields in Saudi Arabia, and then you run it through a refinery. That barrel of oil, the stuff that you get out on the other end, the diesel and the kerosene and the jet fuel and the gasoline, you're going to get different amounts of it depending on the crude that you ran it. And every refinery can't use the same crude, right? So you're buying crude based on what you can use.
Yeah. And every refinery is designed to minimize what it's taking in. And the types of crude that historically we have used for making diesel came out of Saudi Arabia, came out of Russia, came out of Venezuela.
And the sour crudes, right?
The sour, the heaviers, the things that we don't produce in the United States. These are
it's light sweet crude is most of the stuff that comes out of the US.
Right. So with Venezuelan production has been in the dumpster, it's been a dumpster fire for a long time. Russian oil production is under sanctions, and Saudi Arabia has been intentionally cutting back production for basically preserving price in the global markets. You're seeing some of these particular types of crudes that have those characteristics of being a little heavier, a little more sour. You're starting to see pricing contracts above $100. They're this simply because the refineries that need that characteristic of oil have to pay that much more of a premium so they can make diesel, basically. And you're starting to see diesel prices in general outpace gains in gasoline. And so it's a little bit of a technical term, I get it, but $100 oil, that third digit whenever it comes to a barrel of oil really starts to make investors especially really perk their ears up again and go, whoa, oil's at 100. I should be paying attention to oil again. And that's where I think if there's anything actionable out of this is where we start to look at it and go, okay, oil's at 100 again. Does that mean we want to go rushing into oil again? That's where I think things get a little bit more complicated.
Yeah, I think the best way to think about it as an investor is that when we've gotten to this point and you're hearing about it on the financial media, you're seeing it in investing message groups online, that kind of thing, you're a little late to the table when it comes to something like these commodity driven, whether you're talking about precious metals mining, you're talking about oil and gas. When it gets to that point, it's too late to get in. I think that is the point. And Tyler, the way I think about it as investors, let's get into how to think about what to do next part is where you really have to start getting choosy. And I'll give you an example. Pioneer Natural Resources, ticker PXD. I like Pioneer Natural Resources. I think in terms of the independent U.S. oil producers that produce oil and gas, that's what they do. They're not vertically integrated. They don't have pipelines and refineries and gas stations and all the stuff that the big integrateds do. Like they live and die by oil prices, right? So they built a really good business. They have a really low cost base. So they're the kind of company that with oil prices up, potentially, Tyler, they can make a ton of money. They can make an absolute ton of money. But guess what, people? The mind of already knows that. The stock is down about 18% from its high, but that high was like a year and a half ago. The stock has basically held a pretty high price for most of the past year. In other words, a stock like Pioneer Natural Resources and a lot of those other independent producers, Tyler, and I know it's the same thing. ExxonMobil, I know, is a company that you're a big fan of and you've got a pretty good investment in. Same thing. These are already trading for relatively premium valuations at this point. But there are other areas, Tyler, and I want to hand over to you here because there are other areas in the oil and gas space where there is value and there is opportunity for investors. What's an idea or two that you might have?
So I'll toss out two. I think, like you said, there's a lot of, I guess you could say, fully valued things in the market. Pioneer. I would even go as far as saying some of the American integrated oil and gas companies, ExxonMobil and Chevron, are probably fully valued. I think
Yeah, they're
probably
expensive. I don't
trading
think
at
it's
a
just
trading
expensive.
at a considerable premium to its
Hmm.
counterparts globally. And that's where it starts to get really interesting for me is if you start looking at international oil and gas producers outside of the US market, you start to see a little bit more value. A company that you and I have talked about on previous videos, EQNR, trades at a significant discount in terms of its profitability relative to what it can do in the market. I think is one of the better buys in the oil and gas space right now, based simply on the fact that it's so much cheaper than going to a Chevron or an ExxonMobil or anything like that. And then the
So
other
you
one,
look at Equinor and the thesis there again, incredibly cash generative, has a massive amount of excess cash on its balance sheet, pays a pretty good base dividend, and is really working hard to redeploy all of that, a substantial amount of that excess cash in a combination of repurchasing stock at these discounted prices and also paying special dividends back to investors too, right?
yeah, so those are special dividend, regular dividend, buybacks. It's
It's the holy
getting your
trinity
return,
here, quite
getting your
honest. It's
return three ways. It's awesome.
pretty amazing. It really is. Okay, let's see. I know you got another idea there
Yeah.
too.
The other one I think where there's actually some mispricing in the market is midstream companies. It's not a high growth business. The price of oil really doesn't matter for these companies, but their yields are so much higher. They were basically beaten down, during the oil price crashes of the mid 2010s. COVID hit them even harder, and they never really recovered with high oil prices. You know, People look at them and
And
say,
part of
well,
that too is because we've seen interest rates shoot up so much, investors have become less interested in buying equities for yield when you can get a T-bill that's paying you more than a 5% annualized yield and you don't have equity volatility risk. But that's, like you said, that's created some opportunity for investors willing to deal with the volatility to get an even higher yield, potential for growth of the dividend or the distribution over time. And you own the company and the company grows and it can become more valuable if you can be patient, give them time.
yeah, so you start looking in the midstream, you start to see yields in the 7, 8, 9, even 10% range. And I've mentioned it in previous videos, but MPLX, Enterprise Partners, great businesses in these industries with high yields that have proven, they have the wherewithal to return capital to shareholders in a responsible manner and be good stewards of shareholder capital. So those are the two ideas that I think, even in these higher oil prices, when you should probably be choosy and maybe want to be sitting still more, I think these may be ideas where you're not too late to the table.